Morgan Stanley out with a note yesterday, their analyst there, Mike Wilson, strategist rather, that the Fed is nearing the end of its rate hike cycle. Do you agree?
I do not agree with that. I certainly agree with the market expectation that the next move will be a 75 basis point tightening this week. But I expect that they'll move again in December, 50 basis points, 75 basis points, both on the table. And I also expect they'll move 2 more times next year, maybe 25 basis points. So I think we're not nearing the end as much as maybe other people may think that to be the case.
What specific data points or economic reports will you be looking to that would give you more confidence that the Fed is nearing the end of its rate hikes?
Well, recognize that the Fed is singularly focused on inflation. And so looking at the incoming inflation reports will be very important. There will be a couple of those before the next meeting in December. And in addition, obviously, what's driving that concern is a very tight labor market. And we'll see several reports around that going forward as well. And so I'd be looking at those two areas. And I would say right now, while inflation may be cooling somewhat, I think it is still far from showing the clear and convincing evidence that it's returning to the Fed's longer-term 2% target.
How important is this Friday's jobs report? Unemployment rate, rather than moving up, actually went down in the last month from 3.7 to 3.5%, Roger.
I think every one of these data reports will be part of putting together a mosaic, telling a story. So I suspect that there won't be any one report that suddenly swings the pendulum from one direction to the other. It's really, the cumulative impact of understanding where the economy is. And there are many ways to look at the labor market. One of them is the upcoming jobs report on Friday. There's also another report called the JOLTS report that shows the number of openings. And I know, and we've heard Fed Chairman Powell talk about the JOLTS report as well. And so there are a number of reports that will give us a completer picture of how the labor market is faring right now.
And I guess the question there is how many months of a cool down in the labor market does the Fed want to see before it decides to start holding rates steady or even cutting rates? Right now, Fed fund futures indicating those rate cuts to come in somewhat mid next year, Roger?
I think that's a little optimistic as well. I think the Fed will hold rates longer than maybe the market currently expects, and will start to think about cutting rates towards the end of next year on the condition that inflation has actually moved down and appears to be staying there. So I think that's the real disconnect between the market and the Fed right now, is the Fed is saying rates higher for longer than currently the market is expecting. And obviously, the data will tell the story. To date, I think the data has been more on the stronger side and more supportive of the Fed's plan, intention as announced to hold rates a little higher than maybe the market expects and hold them longer than the market expects.
We know the Fed has a dual mandate. It's jobs and price stability. But do you think Powell will acknowledge the pain on countries outside the United States that have seen their currencies move to extreme lows? They're now seeing their debt much more expensive because of the outperformance of the dollar. Will he acknowledge the international risks to higher rates for longer?
He may acknowledge that, there is a stronger dollar, but to be fair, the strength of the dollar is one of the obvious outcomes of raising interest rates. I think he is very mindful that his obligation is to the citizens of this country to create, long-term conditions for maximum sustainable growth. And right now that means getting inflation under control. So I doubt that, pain overseas is going to force the Fed to change its long-term strategy as outlined thus far.
How do you think what the Fed is doing will impact monetary policy? We heard from the Bank of Australia today, and now we await Bank of England next week.
Look, I think each central bank is making decisions for its own economy. Mm-hmm. Many economies are confronting inflation for a variety of different reasons. Bank of England, we see, is confronting, or England's confronting, a very high inflation rate. Others may be slowing more quickly. And so I think what's happening here is each central bank looking at a similar profile of higher inflation, but maybe things moving at a different pace towards slowing. So I do not think this is coordinated movement whatsoever. I think it's a reflection of the underlying economic conditions in each jurisdiction.